Here we are looking at the market up near its all-time highs. We've got reporting season. More than half the market has reported. Seems to be reasonably okay. There are abundance of opportunities, but lofty valuations. The question is, do we start shorting? If we are going to be long, what are we going to be long? How do we find those opportunities? How do we pick the right companies, the right sectors? How do we balance that whole portfolio? They're the questions that are getting thrown at us, and that's exactly what Gary Glover is talking about in his week's report this week. Good morning, Gary. How are you?
Yeah, I'm pretty good. Yeah, that's good questions there, Chris, because it's sort of obviously we're a cracking run in the market there. We are hitting a bit of a soft spot in terms of sort of seasonality in the year, and we've also been hitting a few technical levels as well, which where we normally see some resistance based on historical moves, sort of similar to this. So, yeah, interesting point there. So there's a few things to unlock there.
Well, I'm glad we've got you to guide us through. We've got the portfolio. I'm just looking at a bit of the screenshot here. You've taken profits on a fair few, but you're still fairly invested by the looks of the open positions being sort of the white boxes. And you've been able to add into Ansell, sort of to build into that position with the two of them recently. You got some decent profits that you're sitting on as well. So no doubt they're edging closer to profit target. They might have hit it throughout trading session yesterday. So as we look at the portfolio as a whole, you seem reasonably invested. When you look at it from the blueprint perspective that you mapped out in January, we seem to be getting towards the end of that sweet spot. We're kind of already there. The pullback seems to be mild that you're looking for. So it's not suddenly sell everything, load up on bearish ETFs and watch it fall. So how are you balancing the mixture of you're already invested, you've had good setups, you've got good positions, there's profit, and you're getting rotation into new opportunities, so you're still long, but the period on the blueprint sort of doesn't angle or lean into the best opportunity of the year. How are you balancing that in portfolios?
Yeah, I mean, it's been kind of the green light zone here for, early April into early August. That's kind of the sweet spot for this cycle. So that's been the case here in this market there, well and truly. So our sort of cycles have been bang on the money here this year so far. Our cycles do sort of tell us that we'll probably get a bit of a soft spot here. If you look at those, 50-year cycles, the post-election year cycles, and just other sort of markets that have recovered like this sort of move out of the low and then expanded 25% above that previous range there. This is normally that all those cycles are all telling us the same thing, that we'll probably get a pullback here, a bit of a breather. The positive aspect is if you look at those 50 years, that's the strongest year on the board. So the pullbacks end up being pretty mild. If you looked at the post-election year cycle as well, that sort of August to October period is the soft period as well. That's only averaged around 5% pullback as well. So we don't get big pullbacks in that period historically. And even the 60-year cycle only had like a 4.5% pullback as well. So although the cycle is a bit negative here, we haven't seen too many, or haven't seen very few have a large pullback here. So it's just sort of calling for a bit of a cool off here, a bit of a pullback into the range there. And so if you look at that 2005 chart there, that's the typical gift year sort of setup. So we get a bit of a broadening pattern in the start of the year. We ended up with some either end of March or early April sort of low is the sort of typical cycle for a fifth year. Then we tend to run all the way through to early August, have a bit of breather, a bit of a complex sort of breather there. Sometimes they can be more of a sideways. That's come back a little deeper, and then finish the year off pretty strongly. The end of the year, so the Christmas rally. So that's not too different from the seasonal cycle. The only difference with the seasonal one is normally we run up into April, and then weaken sort of from May into sort of September, and then finish the year strong. That's the sort of only difference from the basic seasonal pattern there. But that's a pretty dominant 5th-year pattern, and a pretty dominant post-election year pattern as well. So, which is sort of been bang on the money here this year. But I think that 60-year cycle, the next chart there, Chris, is a really, really interesting one here, because that's sort of like, it's not the classic, not the perfect sort of 50-year pattern. And then, so if we go back to 65 there, sort of when President Johnson enacted a tariff there on light vehicles, and that caused the market to sell off about, I think it was about 11, 12%, 45 calendar days exactly in length. So that just happened to be exactly the same amount of time that we've just had here in 2025 into that April low. So exact same amount of time here. And, what we learned from that previous period was that within 3 months, the market bounced back to a new high, and then it expanded to the 125 before it had a bit of a breather. So at 125 there, it then sort of pulled back in a bit of a three-wave manner from that high, and came back, undercut the low. So I had, probably a bit of a shakeout there, Chris, sort of the classic sort of Wycroft shakeout, make everyone feel like the world's going to roll over and bit of a panic, and then freak everyone out, and then reverse there, and then go high to finish the year. So wouldn't surprise me if we see something like that. The other interesting aspect there is that high, 13th of May, sort of ran through to the 15th of Nov. So it's literally half a year, sort of high to high for reaction. So, and then we've sort of come back there. So interesting that half year cycle for us is actually rolls out today, tomorrow. So we're pretty close to the same amount of time as that prior move as well. So so we got, same amount of days down. We recovered in the same amount of time. We've expanded exact same amount of, price range there. So, history does not always repeat, certainly rhymes, but this one here is as close as you can get here so far in terms of what's happened historically here. So the good news is we just don't see big moves there, but we can definitely see a bit of a cooling here, a bit of shaking. To be honest, the market's been all one-way traffic here, heading up, Chris, for a while here now. It just hasn't had much of a shakeout at all. And I do think there's a bit of a level of complacency here at the moment as well. So just wouldn't, I think we've got all the classic signs there to see some sort of shakeout here. So I know earnings season's been pretty positive so far. That's quite good. So obviously you get revisions upwards. So we've definitely got interest rates cuts to come as well here. And we've sort of got the AI, what's happening in the AI space is leading to, maybe some job cuts there, but it is helping companies increase their earnings as well, sort of make them a little leaner. So we might get get a bit of a sweetener for companies there in terms of earnings there, which will sort of help, keep those expensive valuations slightly less expensive than they are at the moment. So, but that can still sort of propel you to higher levels there. So I still think it sort of bodes well for the year, but no doubt, we're pretty pricey here across the board. Most of the price to here. So, so we can definitely go through a bit of cool off here. So that's what I think will occur here. Just, just looking at, it's not too many, it's not a big subset of markets that have that sort of fast freak out and then the fast recovery. That sort
You're
of.
talking about market cycles.
Yeah, so I think, I know Mike Webb's IBD calls that the power trend. So when you sort of bounce back above the 21 day and you hold above it for a fair period, that's the power trend, and then that sort of tends to sort of last there. I think the average, we mentioned there was around about 74 days or something like that. Yeah. And I think the longest, that had gotten recently, they got up to around about the 98th percentile in terms of length without breaking the 21-day moving average. So we are getting long in the tooth there without having that little break there. So, so a lot points here to just having some sort of congestion to the cool off here. But the good news is that it hasn't been big in the past there. Right? I sort of measured it out there. If we were just to undercut that low a little bit, maybe come back to something like 6,000 or something there, then you might be able to get sort of something around that, 7 to 8%. But so it's, I think 5 is sort of the average, so maybe we get it just slightly a bit larger there. But yeah, I think sort of something like 6 to 8% pullback there would be pretty tidy there. So, I think it might be worth having a bit of a hedge here. If you still got a few longs like me, you still think your longs look okay, just a hedge against those is not a bad way to look at it.
Well, that's a great insight on the portfolios and how you're running it. So you're not looking for a 7, 8, 10, 15% pullback.
No.
The market cycles, the fifth year, the post-election cycles, the 1965 or 60-year cycle, it's telling us it's pricey, pullbacks on the cards, but it's not panic stations. So you're not
Yeah.
flushing your portfolio out. Are you still looking for longs in the cycle? Are you still balancing the portfolio that way?
Yeah, still a few healthcare names, sort of biotech sort of name sector still looks reasonably robust there. So there's still a couple of sectors showing a bit of strength there. Obviously in metals, BHP was that looks pretty firm here. So there's still a few sectors that still look all right. But that's a good sign is so far in 2025 there, we've seen rotations. So we've seen some sectors cool off here, and other sectors sort of pick up the slack and move higher there. So that signs of rotation to keep going is a good sign here. But, we probably just need a bit of I think we're probably set for a larger, set here. So I have been trying to sort of sell a few more names, try and build up a little bit more cash. But I feel like the hedge is a good way to sort of, if you back your sort of setups and then just have a bit of a hedge on the index as well, sort of, yeah, it's just a nice way there. It's sort of something that professional sort of hedge fund managers would sort of do if they felt like that, particularly if they've had a pretty good period and got a lot of gains on the board. You just don't want to give them up too easily. So, it's probably just a bit time to get a little bit defensive here.
And looking at the Aussie index being so incredibly high, yes, reporting season, we've had some solid reports. Had Combank getting sold off quite heavily, in line with expectations, but listen to Matt Common talk about the outlook being somewhat linked to the overall Australian economy and GDP growth. I guess investors weren't too inspired by that value add. So that has come off, but interestingly, the index is pushing higher despite the heavyweight Combank rolling over and coming to sort of lower levels. On the index, you've talked about the S&P 500, the presidential cycle, the 65-year cycle for the US.
It's funny that 8965, 8966 was the 25% expansion of that range there. So I wasn't sort of sure we'd get there last week, but we got pretty close. We've got within a couple of points of that. So we're pretty much there. So we've now sort of caught up to the US indices there as well. So,
so we've got to hit that upper end that you were looking for and thinking we might get to. Would we as the ASX 200, would that fall into the same space where you're looking for possibly 4-6% drop, that kind of range on the Aussie?
Yeah, it's just super common here, Chris, to sort of when you break out, stocks just appeal this all the time. They break out of a key resistance level, then they run for a few weeks, then they come back and retest that zone, and then they go again. And then we see it on dailies as well. Like you break a daily high, run for a few days, then come back, retest that high, and go. It's sort of technical analysis 101 in some regards. So, if we just come back and retest that last high there, it's actually pretty shallow. It's not the biggest sort of correction there. So it's a little shallower than the US indices there. I think we're probably around that, only around sort of 5.5%, something like that. So you'd be probably a bit narrower than, yeah. So as much as we often we don't tend to sort of perform as well as the US markets. But we don't tend to pull back as much as well a lot of the time. Not all the time, but
so smaller magnitudes for a lot of the movements.
Yeah.
Well, you're talking about daily charts, and I noticed BHP had a lovely coil it was setting up on it. Like you've got the weekly chart in here because that's telling us a bigger picture, a bigger story. So with a lens on the weekly chart that you've got in the report, you're showing us back into 2023, 24. We just in the end of 23 had a false break, eclipsing the old high at the start of 23, so 52-week high, and then it's tumbled for the best part of 18 months, and a bit more now.
Yeah.
What happens next?
Yeah, I mean, look, the positive there is that we've sort of had that, that's been quite a large sort of ABC correction down, quite a large range as well. So to actually come out of that and break above that actually is a pretty good sign there. And you've seen the volumes as well have been pretty robust there out of that low there. So we've been good sort of signs of accumulation as well. So, what happens next? I don't know exactly, actually. It sort of takes, but I do know that that's a pretty positive sign here. So maybe we run a little bit, potentially might come back and retest that break zone. Remember sort of, I think coming out of, might have been October 22, October 23, the index broke out of this similar type of downward channel, then came back, sat on top of the channel, and then popped again. There was a classic sort of Stan Weinstein sort of, what do you call it, our stage 2 break here. So you normally break out, come back, retest the zone, and then go again. So so I think we might break out here. Maybe we cool off here with the rest of the market at some point, and then we go higher there. So, but yeah, it looks pretty positive in the short term. Looks like we can get a little bit more momentum here.
Nice. Well, the next one in your report we've got coming up is Ramsay Healthcare RHC. So the big hospital operator with international exposure, but hasn't performed anywhere near as well as, well, definitely what the directors and shareholders had wanted, coming from $70, cutting it in half to getting below that level. Seem to be trawling it through, and you've got FB, so the false break, undercutting the lows from early part of 2025 to then April, and then a slower grind higher. What's important about how this is moving, and how has that caught your eye?
Yeah, I mean, you got obviously a series of high lows in there. We are sort of finding we've broken out of that downward channel as well, which is a plus. And then we're just starting to break to new highs as well. So that's a good sign there. You might find here, there's a still sort of basing here to me. So I still might do a bit of work there. That volume was good near the low there, but so far it's okay without being awesome. So might just need a bit more work here. But again, I'd probably be looking at those previous highs, Chris, as well on the way out here. So we've seen here, we've had some resistance around that, just under that $40 mark, which is previous high. I think the next high is there probably around about 41.40. Next high is 43.40. So we might just be stepping up here slowly. But I do like the fact that the last 4 or 5 weeks there has been pretty tight. Yeah, that's a pretty good setup here, actually. Sort of when you see the market sort of consolidate under a bit of a high there, not lose too much gains there, that's normally kind of positive that you can come through here. But does report here in about a week's time here. So that's, that I could throw that out. Yes. So, but yeah, the weekly looks all right here. But so I still think it's, the volumes aren't probably telling us this is going to be a bit of a slow climb here, I think. So, yeah.
Well, the next one on the list, Mesoblast, we know you've been a follower of this company for a very long time. You've got a few opinions on how that space goes, how it's unfolding from the international sort of competitive landscape and regulatory approvals in different countries. So I want to say, if anyone is an avid follower of Mesoblast, I want to put the comments below. I'm sure Gary had a discussion on that because he does know this company really well. What I'm echoing from the last chart that we just saw with Ramsay's, you're talking about a compression under the highs. We've had Mesoblast. This is the weekly chart. If we're looking at it, yes, it has been higher earlier in the year. So we're not at 52-week highs, but definitely at quarterly highs. How important is this compression sitting way up on the tight end of the recent rally?
Yeah, so what's important there is that sort of is that show of strength, and that was on sort of on that FDA approval, and then the sort of first quarter of sales on the back of that first commercial product there, which I think is a significant event for the company. I do think that's a game-changing event for the stock here. It just kind of reminds me of sort of 360 and zero getting, as they approach sort of break even, getting commercial there. I've seen companies like in the past, they're like Certex that, kind of wanted aimlessly for about 8 years. And then once they go commercial, start getting sales, then they can kick into gear. So, everyone's probably a little bit disillusioned with Mesoblast because they've tapped the market so often. So everyone's probably lost faith in the company in some regard. But the reality is that they have staked on, they've put a lot of stakes in the ground here. So those, rather than sort of just try to fund maybe one or two different products there, they've tried to go mass market and go big, and it's had to raise a lot of money here. But in the end, if they get it right here, it could be a game changing for the stock here. So some good early signs of strength there. I like the fact that so far the pullbacks have been pretty narrow, pretty tight, and the volume's not too heavy on those pullbacks there. So I do have a 4% position here, sort of a bit lower. It's definitely one that if I start to see this tighten up here again, it's just sort of, I think in that sort of October 24 and even November, December 24 as well, we saw a few tightening periods as well. Yeah. So things like that. So we start to see sort of this go sideways here, tighten up here. I like that. The only thing negative for me is the market might find it tough to etch out some gains here. So maybe that means this goes sideways for a bit.
And it's an interesting space in healthcare. We did a bit of a look into how 40X and Pro Medicus and what the sort of vote of confidence of having a large player in the industry sort of give a vote of confidence, not from an analyst sort of saying let's deploy capital, but actually corporate actions and mergers, acquisitions, those kind of things can play a huge part in this space. So you've extended your report into the healthcare sort of companies really heavily exposed to this kind of upside, and you've got Nanosonics in the report. So Nanosonics, you're talking about FDA again, recently achieved the FDA accreditation. Just before we draw down the charts for Nanosonics, for those who don't know about the FDA accreditation, why is that so important? One for Mesoblast and two for Nanosonics. Like, how is that so relevant?
Yeah, I mean, it's obviously for Mesoblast, it's the first commercial product there. But I think Nanosonics there, so this is sort of more around that sort of software. So they've had a few big FDA approved products in the past there. And then I think they're just sort of upgrading the software. So this is probably just less important for them because it's just sort of like, it's more like a sort of software upgrade. Just means that, I guess the industry there, once it's approved, then the whole industry can sort of, will safely upgrade as well. So, so for Nanosonics there, it's not major in that, but it does sort of support continued sort of strong growth in their products there. So, I think this is in the past, it had some pretty strong growth already, but, that those sort of positive updates there will sort of help that growth sort of keep, kicking the can down the road, so to speak, but it'll just be positive for the company. So, I think this has had a reasonable sort of sell-off here, pull back in that range there. So it should sort of, should be sort of positive for them. So, but yeah, I like
Still at that old high.
Yeah, sitting on the old high there, got a bit of volume starting to come in here. So yeah, some reasonable signs there. I think the sector has been pretty buoyant too, Chris, as well. So it's been one of the stronger segments here. So the old Stan Weinstein sort of, if you're playing in the right sector there, your chances of success are probably a double. So definitely the sector has been pretty strong here. So that's a good sign.
And that's a great insight to be playing in that space. This week's report, you've got so many companies that are really showing in the stronger sectors. Now, you've got some comments. So these comments that you've got just at the end, is that really just echoing what you mentioned before about the cycles, the likelihood of a pullback, and the correction that we could see? Just quickly for those, we do get some questions. So to save them sort of commenting, and we can address it now. How would you be getting short in the portfolio in the context of what you've just described and what's typed here on screen?
Yeah, so look, I'll probably look at a few hedges there, and just look at some, I mean, you can basically write covered calls over the portfolio if you've got sort of some blue chip stocks. If you think they're extended there, that'll give you a little bit of a, you get some, some premium come in, and then that'll buffer some of the downside there. Some of those high momentum sort of stocks there, if they're getting pretty extended there, start to trim some of those back. So sort of trim some of those. So some of the positions even I really like, maybe that sort of run a bit hot, I might have cut them in half, maybe just trim some of them back. And then also with a hedge as well. So if you are sort of playing, you still think your names still look pretty good, your sector still look all right, then buying some hedges there. I mean, the things like the SNAS and the BBUS, they're like a leveraged, so like at least 2 to 1. So you don't need to go out and spend a fortune there to get a bit more. So if you bought, say, 50Ks worth there, those you're probably getting like 100K's worth of a hedge on your portfolio there. So if you just say you had a 200 or 300K portfolio there, 50K will probably, will hedge maybe a third of the portfolio. So it's just about protecting some of the capital in those periods there.
Well, that's a good way of addressing the market, not completely throwing the portfolio out, starting from scratch, but maintaining it, not triggering capital gains, all the issues that we do have trading in Australia. But we say thank you very much, Gary Glover, for the insights on the portfolio update, and we'll see you again later in the week.
Thanks, Chris.